nothing a presenter likes than the things for the Murphy Law effect to take hold. All right, this is a scan on my TradeStation platform. We're going to talk about this today, but I thought it would be neat to say, all right, if we were going to take a scan today, how many stocks generated what I find to be a quality trigger? And it is a couple of indicators that I like to use, and then we'll get into what happened with my predictions and where do we go from here. So because I'm 50% wrong already on the predictions of the market based on what happened in these 4 trading sessions. So with that said, we generated daily high close doji. I ran a scan, I want you to see, just NASDAQ. And I guess I could mess things up and run NASDAQ and S&P 500. I'm going to run that live right this second. This is how many stocks generated at low close doji. And we'll talk about what the heck the low close doji is. You'll see that it's S&P 500 and NASDAQ. I already ran it. And as you can see, the results down here, it's at the very bottom of the screen. You can see that this says results and data as of today at exactly 4:29 and 38 seconds. So this gives us a total of 58 stocks did not generate buy signals. They actually generated daily sell signals within the NASDAQ and or S&P. That to me is not a low close doji. It's a low close doji is after a rally, but there was a doji yesterday and the market closed below the doji, so it's running that scan. We need to do a little bit more filtering here, but when you take a look at the sectors that generated, energy kind of stands out, some technology, these are some small cap names, $5 names, not a lot of really quality names popped up in the triggers for tomorrow, all right? So this, what I want to share with you, and this is almost done. We're trying to run a scan of 2,728 names, and I wanted to get through to find out what was the quality, number one, of today's. Were there some high close doji setups in the market today, and what was the general area of interest? Well, this is Abbott Labs, and obviously that is a little bit of a downtrend, and you can see that we generated a daily high close doji in Abbott Labs. So I go healthcare, 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 so I'm getting the idea that we had a lot of daily high close doji. This is Accordia Therapeutics. There were an enormous amount of healthcare stocks that generated some quality high close doji buy signals today. If you look at this sector, it tells us what the names came from. Healthcare. Some transports, like expeditors, if you want to call it improperly, like I just did. I just butchered that name. And what's kind of interesting is the whole, and we're going to talk exactly about transportation, because I was actually today thinking we would see a lot more, and what I'm scanning for is the quality of what does populate as far as buy signals, number one, and what sectors populate in buy signals, all right? So as you note, we only had 89 names. VeriSign's another one. Most of you are familiar with that stock, VeriSign. What are some Ross Stores is another one. PNC, which has earnings out on Friday, a bank, and we're going to talk a little bit about the financials in just a minute. So with today's price action, there were some names that did generate a daily high close doji, and what does that all mean? So let's we've got a lot to talk about what those particular setups are. So I'm going to stop the projection. We're switching pages now, so bear with me. This was more for our group tomorrow, just to let you know. We just ran that scan for right now, but I also wanted to share it with our visitors for today's presentation. And we're going to start the record button, and we should get right into our presentation. And so What does all that mean? There was already, what is a high close doji? Bullish? Yes, Stephen, it is bullish. So Terry, exclude the stocks under $5 to shorten the number of scan stocks. Terry, smart type. TOS does not have this scan. This is a proprietary scan that we created, but we're going to talk about this scan and what it really means. It's something that I wrote about, let's see, this is now 2016, 2004, 12 years ago in this book that was put out called Candlestick and Pivot Point Trading Triggers. So if you're not familiar with my work, first and foremost, before we begin any further, let's start with the proper disclosures so that you know risky is the key word for trading. Past performance is not indicative of future results. The information contained herein is educational in nature, and it is for the use of individual traders, not to be reproduced or retaught or copied, pasted, and reused or regurgitated without my permission. So that's my lifelong work, and I stand by that. So today's topics, as a follow-up, I wanted to start January on a two-part scheme. Just to share with you, not every trade's a winner, and certainly there are certain mitigating factors that we get things wrong. And I am wrong on 2 accounts on my predictions for this year based on the analysis that I use. Now, didn't cost us much money because we were looking for a breakout trade to see if things supported, which we didn't. I'll get to that in a minute. And that's what we have. Today's topics are determining directional ideas, setups versus triggers, execution, what defines a trigger. And then, of course, trade management, risk reward, and order placement. What's a good way to look to put yourself at a better spot on order entry? And regardless whether you're using directional option strategies or not. And again, I wanted to cover this because a lot of people tend to have this all-in mentality. They really feel strongly about something, and they don't use correct position sizing guidelines. And I just wanted to define that in today's topics. As far as what I shared with you, the scans, I did this backwards. That was kind of like a bonus to share with you what a high close doji, how many populated in the universe of stocks today. And we're going to talk about what the high close and low close doji is as far as a trigger or a pattern, and touch base on that right there under execution and triggers. So anyway, some of my predictions. Last week I said I thought we would see crude oil trade to 45 before we see 30. Well, we saw the market trade under 30 today. Is it a sustainable low? That's a different story. Typically speaking, we had a light volume sell-off until we started Wednesday, Thursday, Friday, Monday, and then it kind of cascaded. I was looking for the market to break out back above the 36 zone if we were going to get any full momentum going in the market. Unfortunately, we didn't get it. So we were back to the drawing board for that one, and I scratched it right off. Gold trades back under $1,000 before June. That has a very strong likelihood of happening, especially in this environment, knowing how the market traded today. This is the seasonally best time of year to be buying gold up until the end of this month. Gold couldn't manage and maintain its buying structure, or at least the sellers came in full force today. Gold ended up down about $8, $9, $8.70 more or less. Twitter, I think Twitter still trades back near 35 before June. And last but not least, the biggest one we got wrong was S&P 500. I thought would trade back to 2080 before we saw 1940 before Feb 15th. Now, what's the story with the S&P 500? Well, I'm going to get into that today. And I'm going to share with you some charts that I think are very relevant in today's market environment. Do I still think that we're going to see the S&P trade to 2080 by February? Not after the technical damage that we just experienced. No. If we can get the S&Ps to test, let's drop that number down just a tad to say 1980. That would be maybe a miracle at this point in time. So let's take a look at what indicators and indexes I'm still watching. I still think it's very important to watch the FXI, China stock market, as far as economic reports and indicators to follow. Leading economic indicators, the LEI, the ISM Purchasers Managers Index, and employment, both here and abroad. We need to follow that. I still think that, especially with this crude oil trade, and that's what I think this market is under right now, it's a liquidation mode. We're not seeing a lot of quality flight to safety. They're certainly not buying gold. Bonds today, at the very end of the day, got a little bit of a bid. The dollar isn't really doing anything. And when I say a bid, that means bonds rallied today via price. Yield went down. And typically, bonds and gold have been a flight to quality trade in the past when people are very worried about equities. So I think what we are seeing is more of some hedge fund liquidating, and you're starting to see some redemptions. Redemptions mean someone says, hey, how much do I have left in my account? It's not good. Close it for me. And therefore, they have to liquidate the person's holdings and then send them a check. That's the key word for redemption. And that can cause short-term turmoil from asset liquidations and increased volatility. And that's what we're kind of seeing. As a reminder, if you weren't here with me last week, I went through this kind of like to try to figure out where are we in the business cycle. And I think, you know, when you look at typically what happens to markets from an early contraction to from coming out of recession, going into early expansion to a middle to late expansive move, you typically see capital goods and basic materials rally, and energy is on fire. And we're certainly not at this phase of the economy. Consumer staples and utilities. Utilities don't look very pretty at this point in stage. So I don't know exactly. It's kind of a hard thing. Financials, transportation, and technology, and the whole thing that's been leading this market, at least last year, and as we discussed, what's been leading the market? Well, the best performing sector was the technology and biotechnology laden sector, the NASDAQ 100. So technology, transportation has not been leading this sector. In fact, transportation, if you take a look at the trannies, the TRAN, or an ETF, the IYT, and I shared that with everyone last week, the IYT is down from its peak in December of 2014. The transportation sector is down about darn close to 25%. I think it's 24 point something percent. So we have the transportation, the transports. Energy's down hard. Transports aren't moving. So maybe as well, people trying to scratching their heads, crude oil was going down, energy costs was going lower, it was going to put more money in people's pockets. Why hasn't it done so? Well, maybe because of the fact that we've seen an increase in housing sales, maybe because it was the holidays, and maybe because we haven't really seen the full effect of consumer spending, and perhaps maybe one of the topics we covered last year, seasonal analysis. So maybe that can kind of explain a few things. So when I talk about the market, this is the subsector transport. This is a weekly chart. You'll notice last week I used a lot of tools from TradeStation. This week I thought it would be nice to intermingle a few of my favorite things from Thinkorswim, and this is a chart straight from Thinkorswim, approximately less than 30 minutes ago. So this is not, as you can, this is not an old chart by any stretch of the imagination. This is from today. This goes back as far as the 2011. You can see the significant upturn that we had in 13 and 2014. And here is the high on the IYT. And here's the current trade price. We formed a little doji today in the IYT. But here's what's the most interesting component about that little sell-off in the IYT. It came after a huge increase, and the market's pulled back into this shelf of old resistance. And if we take an examination, an old favorite tool of mine using OBV, that's a volume indicator, we will note that the price is almost right back to where it started from, or before that little breakout ensued in the late, I guess you want to call that September of 2013. And here we are in a volume reading, not even close. So there is some things that we scratch in our heads as traders saying things don't make sense. You can't have energy down, transportation down, and if the market is just going to crash all at once, then why isn't it on stronger volume? And to me, I think that's something that really needs to be explored. So I think today might shed some light on why there is this cautious tail and why I was not really looking for the market to do what it did Wednesday, Thursday, Friday of last week, let alone a little bit of Monday's lower open. Here's the another interesting component. It's called the Vanguard REIT ETF, the VNQ. The VNQ, while it's not near its high of last year, it's certainly not near its lows either, and it hasn't had any major movement in volume, so it's not seeing heavy liquidation. In fact, even up to last week, it didn't even get, note here, it's not even, and this chart is not from 2 weeks ago, this chart's from 30 minutes ago. The VNQ is not yet close to its August 24th low. So I'm looking at this going, look at the trend direction of the volume. While it's not generating a lot of technical buy signals by any stretch of the imagination, there's no blue arrow, a PPS buy signal, it's not liquidating on heavy volume. So that to me raises a second red flag. All right, seeing as I'm using Thinkorswim today, I thought I'd go and look at the financials, the broker dealers, and look at our parent company of Thinkorswim, which is TD Ameritrade, stock symbol AMTD. Now, I look at this chart, and I would, I've already outlined it or highlighted it in white with you. So are we in a top or a trading range? And if the market is going to crash, then what's the first, or at least a few of the top sectors that would start to get thrown out? When people use the phrase, I'm throwing the baby with the bathwater out, they throw everything, right? This is not compared to where we started from in 2000. This goes back since only 2000, just right after 2011 here. This is 2012. This is quite a rally. This is quite a strong uptrend. It hasn't done much, chopped around after the big rally that ensued. Is this a trading range, or is this market getting ready to break? It's a trading range. It's the bottom of the range. All of the evidence that I have in this market is it's at the bottom of the range. The funny thing is it's at the bottom or near the bottom of a trading range, and there's no concernable heavy volume selling going on in this stock. And so if TD Ameritrade represents a lot of small speculators or individual retail traders, either retail traders had a lot better education than some of the hedge fund managers, or are things really as bad as the market's projecting it to be? We're not seeing, and again, one stock in one whole sector doesn't tell us the story. So let's look at Charlie Schwab. Charles, or call Chuck, as the commercials used to say. Charles Schwab's more an ascending trend of the market, and so is its volume. So we're not even back down to where we were at the August 24th lows. We're close, but we're still in a defined uptrend in the market. We haven't even broken newer lows. So what are we? Are we in a channel, or are we in a beginning phase of a bear market? Well, we do have at one piece of evidence. The only thing that I have here is I have lower highs and I have higher lows. I haven't broken down, and I certainly haven't broken down in the last 5 weeks. 1, 2, 3, 4, 5, let's call it 6 weeks. In 6 weeks that this market has shaved off the highs, what's the volume trend doing? It's actually up. So ironically, it's not being taken to the woodshed either on any significant volume. I find that to be a very compelling story. All right, so we got some broker dealers out of the way. Let's look at some banks, and let's look at the top of the, or the bottom of the food chain, so to speak. Bank America, as you know, inherited, and if you saw The Big Short, you know that you remember Countrywide. Well, Bank America is Countrywide, right? They inherited they consumed Countrywide or vice versa, and it's also part Merrill Lynch under the umbrella. So Bank America, what if the financial community is going to rock to the downside, and if the equity market's going to go down, what are we? Are we in a downtrend, or are we in a sideways channel? And more importantly, what does the trend direction of the volume insinuate? So for me as a technician, at least as a trader, to come up with my own conclusions rather than listening to the boob tube, what I want to do is take a look at markets and say, if the market is going to at least define a meltdown, right, and go in a downtrend. So let's just define downtrend, right? If it's going to go in a downtrend, which it's done in the past, it's probably going to go in a downtrend with a defined downtrend in volume. So if it's going to maybe go in a sideways channel, maybe perhaps the volume would be in a sideways channel. And actually what we see is the volume is more of an uptrend. So where's the volume that would tell me we should be liquidating positions and selling this thing off? It is a perplexing point in the marketplace. This, to me, is a very perplexing pattern. So, all right, fine. It's one stock in the sector. It's not this sector. What about Wells Fargo? Again, similar story. Trading range pattern. It hasn't broken the downside of the market. So is this market getting ready to crash and burn? And if it is, perhaps test the bottom of the trading range first, backs up to maybe this area, and we'll get a clue on the next upside rally. If we do get a decent upside rally, if the market does get an upside rally, if there's no volume behind it, and then we start to generate and roll over, then we could see if the volume starts to roll over. We have a very strong, formidable market breakdown. Remember what they say about trading ranges. The longer a market stays in a trading range, the bigger the breakout or breakdown is, right? I didn't make that up. It's in the history books of technical analysis. And so if that's the case, if the market is going to be in a breakdown, that's where we would pay attention to volume analysis and say, gee, if the market is going to break down, wouldn't it make sense that at the very least, if it breaks down an old low in the marketplace in here, if it breaks that out, why can't the market make a newer low in volume? So again, here's the market, which we would call this a slight bullish convergence. The market indicator down below, this OBV, is tracking the volume net changes of an advancing versus declining day, or an up or a positive gain or a negative gain or negative loss day. A positive gain or a negative loss day, right? And it's a cumulative tally, and it's based on the close. So if the close last week is lower than we had here, why is the volume higher? As you can clearly see, this is a bit of a convergence, and that again is a what? To me, it is another question mark, a perplexing scenario. So is the market in a downtrend right now, or is the market in a trading range? And if we are experiencing a market meltdown, and if this is going to be a stock market that's getting liquidated beyond belief to biblical proportions, yeah, it's got a long way to go, possibly to come back down into this zone, at least for this instrument, to test support again, right? That would be probably a good, meltdown in the market. Well, if that's going to be the case, there better be ensuing volume to go with it. Until then, the market's in a trading range. That's what the chart action looks like on a higher degree time frame. Now, we've looked at some broker-dealers, the top dogs in the sector. We've looked at some banks. And now I want to take a look at some seasonal analysis with you guys. And before we begin, a lot of people are into seasonal analysis, and then all of a sudden, the one time it doesn't work, they say this is garbage, and they leave it alone. And that's what I think one of the biggest con of the pro and the con listing is. The simplicity of the tool enables the user to forget to use confirming indicators. Not all years are created equal. This is a very difficult market environment, and I think it is at the very least, we all know that crude oil is, at least the media saying, hey, look at the weight that we have on these indexes, with crude oil down nearly 3% today. Crude oil was down 2.77%, testing that $30 mark. what's it doing to the some of the financials, which supposedly have all these bad loans on their books from all of these energy companies, right? If that's the case, we don't. There's some bigger names in the energy or the banking sector and the broker dealers that haven't started to see that follow through selling pressure. Now, transportation on the cheap energy side should be picking up, and that's a quandary. So seasonal analysis can maybe help us. Maybe the reason why we're not seeing the transportation stocks rally right now is maybe this isn't the typical time frame of the year for them to rally. Interesting concept, right? So that's where seasonal analysis, putting one and one together, might help us for some bigger trades. And I'm not talking about day trading. I'm talking about bigger trades, riding a trend in the market and putting it together. When the markets confuse the majority of people, that's when they kind of tend to make the biggest moves, when the least amount of people are with that trend, right? I mean, isn't that it? How many people saw the movie The Big Short? If you haven't seen it, I suggest you see it, especially if you're a day trader. Because if you're a day trader, I think, or even an option writing strategist, you might find that, you know, a lot of the money these guys were making was not on a short-term trade. It was on a long-term trade. And they had a position, and they were properly positioned. So I think if we're going to be looking at the marketplace, it's a great story. It's a true story for the most part. And, you know, it is an interesting, at least from my end of experience, looking at the majority of trades, at least from a commodity background, when I first started trading bonds, I can tell you this: position trading and having a decent position on was the big money to be made. Day trading's great, and in this environment, a lot of people like the day trade concept, and I get that. And I'm not immune to day trading. We had a nice day trade today, but needless to say, I think that looking at the seasonal trend might help us uncover some better opportunities in the market. So with that said, let's take a look at the internet sector. Google, Qualcomm, Amazon, Cisco, Time Warner, eBay, Baidu, Red Hat, Expedia. Typically from a seasonal perspective, this is not the greatest time of the year to be buying those types of markets. So perhaps we're going to be seeing some, as you can see from the January, what typically we get is a January break. Now this year came early, like right out of the box. Typically we see some upside pension fund money come into the market and then it goes down. This year it just came right out of the box and went down. So, you know, give or take a week, was it early or late? It may have been the sell-off was a little early. Now, retail. Now here's an interesting concept. Typically, you get coming out of the box a little bit of a meltdown in retail, a little follow-through coming out of January. But then as you end the month of January, you start to see retail stocks start to move up. Already we saw Signet Jewelers, Super Value, even Starbucks, Nike. If I'm not mistaken, some of those names today had some pretty good moves in the retail space. If you take a look at what comprises retail stocks, I mean, a lot of things were up today. I get that. The XRT, for example, XRT was up less than 1% today. The XLY, consumer discretionary, was up about the same percentage amount, less than 1%. When you start taking a look at names in that space, like a Super Value, SVU, Super Value, not a great stock. It was up a little bit today. It formed a doji, actually. Like to show you the chart, take a look at some of the names that are in here. I'm not a big, SFLY, Shutterfly, right? They make, you can send them photos, they make books, and they send it to you, that type of thing. I think Shutterfly is the company. I'm not sure if I would want to get behind that. I need better information. But WBA, which is what, Walgreens, there are certain names out there in the space that perhaps we start focusing. Maybe there's some nibbling going on in the retail, and you should maybe be focused on that rather than giving up the trade. Maybe be focusing on some of these retail names, and maybe the market's reaction to consumers spending money with all that extra cash they have from not putting in their gas tanks, maybe it's a delayed reaction. Maybe there's a delayed reaction. So perhaps that's something we need to kind of focus in on. What would we be looking at? All right. I have a better thing, Bill L. Your question about my seasonal should have a standard deviation band so I can see the reliability of expected moves. I also like to look at the long-term duration compared to a short-term duration. For this particular guide of 45, 50 minutes that we have together, I like your comment, though. In addition to that, I think it's very important to understand that not as that pro-con list stated, there's a little bit more to seasonalities. Therefore, you need to have a little bit more corroborating information to it. But it's definitely a guide. That's what we're trying to put out here. Thank you for your comment, though. What I like to do is not to always tell people, technical analysis or market condition supersedes seasonal analysis. One, there is no holy grail of a single indicator, but I think we stack our odds of improving our chances of success by combining a couple things. And one of the things I like to combine is, of course, my concept of what I share with people is the strength in numbers concept. I don't like to look at just one stock in this sector, for example. I like to look at multiple stocks in a specific sector. Thus, the reason I ran the scans today and shared with you guys live what did we find as far as buy signals today, number one, on this next topic called the high close doji. How many of those stocks were in a specific sector? And again, yes, we can filter out a lot of different things like volume. We can look at getting rid of the stocks under a certain price, and there's other filters, or you could just run a scan in the S&P 500, and that solves kind of your whole problem of small or what I'd like to say low capitalized names. But today, quite frankly, we got a few names in the healthcare sector and also in some service sector. One called a form that you guys might want to watch tomorrow for some follow-through is Electronic Arts, the stock symbol's EA, if you're interested in that. EA had quite an interesting pattern over the last 5 days. 5 days, Electronic Arts, while the equity market went down, it kind of hasn't dropped, and it's formed in the last 5 trading sessions. 3 of the 5 days have been dojis. So today we finally closed over the high of the doji, and I'd like to share with you what is the high close doji setup. Actually, if you come to if you'd like to read more about it, may I invite you to go to, and I'm going to share this, and I'm sure everyone has been or has seen the website before, right? There's all kinds of information that you could look at in here for tools, information, a lot of great stuff that we've written that you can find out about, a blog, for example, and a lot of things. And when I talk about the books, it was that book that was written over 12 years ago, Candlestick and Pivot Point Trading Triggers, still available on Amazon. And this book here, Mastering the Stock Market, by the way, excellent books that go over this material. The high close doji is a pattern that I discovered now in its 20th. I never could find that amazing, most bullish setup, the morning doji star pattern. But what I did notice is that a lot of times the market within so many bars after a downtrend. So here's the key word. I said after a downtrend, all right? The market, if this hash line represents the high of the doji, it would close above the high of the doji. Therefore, ensuing a trigger to get long on the close or the next bar's open, and my stops would be underneath the swing low. And then I would need to see the market provide immediate results. I'd want to see a market perform either a higher high, a higher low, or some type of ensuing bullish pattern that would maintain a potential trend or a reversal pattern. So instead of guessing and catching a falling knife on the way down, we waited for this pattern to ensue and then look for the market to close above the high of the doji within X period bars. Okay? So just as an example, after a quick downtrend, you get the market that forms a doji. Now, I always found within a tick of, or what I call a statistical relevance, is that in a wide range bar, wide range, meaning between the low and the high, wide range, if the market closed within X% of the open, and generally it's in the S&Ps less than 3 ticks or 0.8% of the market, it would generate a doji for me from a computer programming perspective. I would also look at within, if the market closes over that high, it generates a buy signal. It generally is comes before a PPS buy signal. It's one of the fastest known buy or sell signals that I have seen, and it generally within a couple bars we should see positive performance, either higher highs, higher lows, and we should maintain a trend, and then we should see some upside. In fact, today one of our trades in the room was on a high closed doji pattern, and it was quite effective. It was more effective based on the combination, and again, it's not just about one set of tools. The market had a newer low on the day on higher or lighter volume, shall I say in this case. So we had a volume convergence. This is the doji, there's the high closed doji, and that was the trade that ensued for a profitable setup. Now, ironically, this was today, by the way. So just to let you know, this isn't from 1933. This isn't from 2004. This was from today. So it's still a very effective tool, why we've even created scans for this particular setup. Now, the low closed doji is very simple. It's just the opposite. So for a trigger, after a rally ensues, we see dojis. And everyone's probably heard about dojis. There's a lot of people since Steve Nissen and Greg Morris popularized candlesticks. There's a bunch of other people that have followed suit and written books, including myself, on candlestick patterns. Dojis are not in of themselves. And what is a doji? A doji simply is that the market, after forming a range, the high and a low, it has no real range of the real body, and the real body constitutes the difference between what we call the open, which is a hash mark right here, and the close, which is the hash mark right there. If the open-close relationship, as I've already defined, is less than 8% of the overall range, it's classified as a doji. Note with this candle, that would be on a black candle in a black and white picture, that would signify that this is the open, and that is the close. You could see there is a box, right? You could see there's no box, and you could see this is a big box, a bigger box. And you can clearly see, if this denotes the close, that the close is below the low of the doji. So the market has, in essence, made a defined change or conditional change in the market. It isn't just a lower high and lower low trend. The market has actually closed below a previous low, and that is the trigger to enter a short position on the close right here or the next session open. So therefore, after you see a rally in the market, then we have a place to define our stop, and we can now see that the market has turned. So this is a very important element of the market. Whether you're looking after long upturns of the market, you see dojis. When markets close below prior lows, but more importantly below the doji, we generally see immediate results in the marketplace. By the way, this is today in the bonds. While we did not, I personally did not take this bond trade. I will tell you when I do and when I don't take trades. I did not take this bond trade. I did take the high close doji in the ES, but this particular was funny because while the stock market was, today declining and everyone was a little bit nervous, the bond market went right up to a couple iconic spots. Monthly person's pivots. It's near monthly person's pivots, and it came right at today's daily person's pivot level. Now you notice that this is the Thinkorswim brand logo charts, and these are, as you can see, 2 time frames, the person's daily and the person's monthly pivots, and we had a low close doji occur for a short-term trade if you're a bond trader right at the intraday resistance and near monthly resistance. So I find that to be after markets rallies and they're near longer term rallies and they're near higher degree time frame points of interest, such as the pivot targets. When you get these types of triggers, you can see that this setup that I've circled in white is very similar to this pattern right here. This pattern right here, I plagiarized my own work. That what you're looking at is a direct copy out of my book called Candlesticks and Pivot Points, which was published 12 years ago. So it is still, as it was powerful then, still an effective tool to this day. So, I don't look at this just as for day trading. We look at also for end of day trades, just as I was scanning for and shared with you today. And I think that that's kind of when I find a day that has a doji pattern like yesterday, there were numerous stocks that actually formed doji. That's a setup. It's not a trigger. A trigger is if you get a close over that doji high. Now, what's really important is the higher the time frame, the better or higher quality the setup. So if this week, by the way, if we start to form more weekly high close dojis, we'll probably get a few week rally out of the market, or at least underlying sectors. So what my thinking is from a top-down approach is, in the next couple weeks, as we get more uncovering of, the smoke clearing and the dirt kind of settling a bit, right? We see that the financials, as I've illustrated, and the broker-dealers, at least these top 2, Thinkorswim or TD Ameritrade and Charlie Schwab, as the dust kind of settles, we'll get a little bit more, I guess, insights as we cover earnings season, which is upon us in full force next week after Martin Luther King Day holiday, right, Monday. And I think as we get an insight or a taste of the financials, which will be on Friday, incidentally. Friday we have who? Wells Fargo, Citi, and PNC, just to name a couple or a few. And more importantly, if we get some weekly high close dojis and it is concentrated into a specific sector that is entering a seasonally strong period of time, it gives me a little bit more confidence to put some money to work. All right? Now, obviously, I look to these types of trades first off for day trading, and many of you already came in early, right after the cash market closed, who were in the room, and you actually saw my charts look very similar to this. Very simply put, we start off with looking at, for day trading, the ES, the NASDAQ. Typically, if I'm, I'll also have, of course, the just as a sample, at the very least, a 5-minute chart and as well 15-minute charts. I also like to look at 60-minute charts. I'm not going to lie to you. So we typically have 5-minute. We typically also have 15-minute, and then we have 60-minute charts to get a dominant trend direction of the market. I look at not just one sector. Or like ES, I look at the NASDAQ, the Russell, and of course the YM. We look at ZN or bond notes, bond ZB, Euro currency. Those are the kind of the markets that are more active for day traders. And the 2 time frames that I look at is if, for example, we get a 15-minute high close doji, right? A 15-minute high close doji, I can use that 15-minute high close doji and maybe go with buy signals on an intraday time frame and go with the directional trend. Those are just different ways to play off the market. Go with high close doji patterns, which give us an early warning signal before markets see some upside. As far as day trading, since we're not sitting here, sometimes day trading, we're just looking for a quick pop in the market. It can be considered as long as 2 hours. It could be considered all day. It could be considered 2 minutes or 30 seconds, right? So for the most part, if I get a high close doji on a higher degree time frame, and in this environment, typically we look at a 5 and a 15 minute. In this environment that we've seen in the last 7 trading days, with the average true range over 40 handles, 49 points in the S&P, when you're getting a 5 to 7 handle move in every 5 minutes, it's a time frame that needs to be changed. And in this environment, as a day trader, many of you are already proficient to understand you should be using maybe a 1 minute and a 3 minute combination time frame. I'm not here to teach you how to day trade. I'm only sharing with you how to set up your charts and how I use them in conjunction for identifying higher probability setups and triggers like the high close doji. Okay, this is considered a high close doji, by the way, because it's within the proper time frame of the close above the doji's high. So it does help to utilize some of these triggers in how efficient they are and effective they are. It's a pure trading system. It tells me when to get in, how soon I should expect results, and where my stop goes. That's what's so neat about that high close doji pattern and the low close doji pattern. So I think many of you last week, we talked about the PPS indicator, all right? The PPS indicator on Thinkorswim, and people see a series of moving averages. And what are the moving averages about? And to start you off for 2016 in trading, just like a moving average, it describes just that. It's an average of price that moves, right? And so a couple things that we use moving averages for, not to be simplistic, is, I guess, a picture speaks 1,000 words. Let's say you miss the trigger on a low close doji. You missed the trigger. The market might, the next bar open a little bit higher, and then all of a sudden the market slams down, and you've missed the trigger. Typically speaking, in an early phase of a market reversal, what we would look at, the moving averages, what we would be looking for is a snapback to the moving average to lean against, and then say, listen, instead of chasing the market here and having my risk way up here, from a technical perspective, say maybe the market doesn't get exactly to the MAs, maybe the market gets maybe 75% back. So instead of placing and chasing the market, maybe placing offers and look for the next bar to come back up. If the market truly is in a downtrend, if it is in a downtrend, right? After all, won't it kind of do the zigzag pattern, right? Zigzag pattern. So what I've been teaching my students and in mentoring for a long time is what we call that snapback approach. Now, I'm sorry to get all squiggly on the line. I generally should never have a pen in front of me, but typically I look for a snapback approach, and instead of resting offers at that moving average, I typically look for a market to snap back near the resistance, and if the market is going to continue down, then I get filled on the entry and then place my stop. If the market just breaks straight to hell in a handbasket and I didn't place the entry and I'm not filled, just cancel both orders. It's real simple. So we like to sell rallies, and at 75% snapback rule. So instead of placing your order right at the moving averages, the distance between the close to the moving average is 75%, and a lot of times if you do that, so if you think about it, from the close here to the last known value of the moving average. I mean, this is what, 50% more or less, something like 50%. That's something like 75%. And then you get filled or better, the snapback rule. So today's presentation is how do you take actionable signals and trade with them, right? What's a trading trigger? Well, first off, we've got the low close doji trigger. Second off, when the market shows follow through, how do you take that trade? Well, you can look for snapbacks, whether you're looking for sell signals or whether you're looking for buy signals. The reverse is true. Okay? So looking at a market that finally gives you a potential sell signal, and you go, holy moly, I'm going to miss this. You know, the market generated a sell signal on the close, and my stop has to go up there, and I'm not sure I want to risk all that. Now, this is a weekly chart. So what I would do is say, well, you know, if the market comes back 75% and I want to be a directional trader, if the market gets into that level right up in there, 75% snapback, maybe I'll look to be selling the market at that level, get filled on a snapback. Otherwise, if it continues to crash and burn, it's going to move without me. I'll have to look elsewhere. But at the very least, I've defended myself, reduced some risk, number one, and number two, I allow the market to do as I've just described. It kind of gives that zigzag, and that's what the moving averages are all about when you use the PPS indicator, okay? So on Thinkorswim or any of my indicators, whether it's Genesis Trade Navigator, which is what this chart is from, it's what you saw in the trading room when you first came in, or if it's TradeStation, whatever it is, same concept of how I utilize my trading system. So, John, I noticed that I ran some scans and I got a lot of PPS buy signals. Everything's looking good, and I'm going to go and buy a boatload of product. Or as some people say, I'm going all in. I'm going to get rich quick. And it's not about getting rich quick. It's about consistent trading. It really is. And I know everyone wants to hear how easy trading is and how simple things are. And if it was really easy and if it was really simple, then everyone would be making tons of money. But the fact is, trading requires discipline. It requires a system, and it requires consistency over time. Not every trade's going to be a winner. Not every call is going to be great. You're going to have winners. You're going to have losers. The key is to be consistent over time. And I find position sizing, at least for equity, something I wanted to tap into. This is not an absolute rule, but it's at least a defined rule that, you know, if you're looking at risking 2% of your account on a stock, let's say, maybe you want to risk a little bit more than that on a futures or an option strategy. But literally on a $100,000 account, if you're risking 2% on a trade, easily you know you're risking $2,000, right? I mean, if after all you're wrong 10 times, you're out 20% of your equity. So you got to kind of be able to be defining your risk per trade. And then whether it's options, an option strategy, you got to be able to, and I always like to at least introduce people, if you've never heard of position sizing guidelines, if you're buying stock XYZ at 1780 and you feel that your stop needs to be under 1520. So let's say you've got a daily high close doji pattern and you're going to get entered in here and your stop has to go there. And the difference is buying the stock at 1780, right? You're buying 1780, and then, of course, your stop loss is 1520. Well, you're risking $2.60. How many shares should you trade? Real simple. Well, as a guideline, 2%, $2,000. It's a pretty simple formula. Very, very few people actually follow it, but it is something that's simple. 769 shares. You just take $2,000 risk divided by 260, which is your stop loss, and there it is, 769. So round it up, say 750, or go simple math so you can keep a track of it. 800 shares, for example. at least you have a game plan of what your risk factor is on your trade, no matter how great you like it. Maybe if you really like the trade, you can increase your risk factor to 3%. You know, maybe you've been around long enough and you know this. The more trades that you really like by your gut, right, those are the ones that generally kick you in the ass. I hate to say that, but it's true. I mean, some of the trades that you'd say, oh, this can't lose. This is, it just can't go any lower. This is just the greatest trade in the world. Those are the ones that generally don't work out well. There's a famous trader in Chicago in the bond pit, Tommy Baldwin. And Tommy Baldwin, I mean, this guy was the whale of whales, Tommy Baldwin. There should be, at the Chicago Board of Trade in the bond pit, this guy, if there was a whale, this was the whale, Tommy Baldwin. He was so wealthy, he bought a skyscraper in Chicago called the Rookery Building, right on LaSalle Street. In fact, they filmed the movie The Untouchables with Sean Connery in the lobby of that building. And he always stated the trades that put the most butterflies in his stomach, that scare the bejesus out of him, the dickens out of him, that's usually the trades that work out the best. The trades that scare him the most. The trades that are the most comfortable, those are the ones that generally don't pan out. I don't know why. Maybe you've heard this phrase before from traders, but you know, that's why you have a trigger and to have a risk factor is very important. And to have proper position sizing is encompassing of the market. This is a business where we're trying to handicap where prices can go to help figure out, to reduce risk and increase profitability. And some of the tools that I've shared with you last week and then again today, these are the things that I use day in and day out. And if you've seen me before, you've come to seminars or you've seen me at trade shows, you know, it's almost the same old story. I thought it was fabulous to see, you know, to wait patiently today for the right setups and get that. It's really a true gem, because typically speaking, while not every day's, you know, a fantastic trading opportunity, some days are better than others. Typically, you can find some decent trades, especially with the techniques that we use here. So, as I always tell people at seminars, the key to success: unlock the door to knowledge and improve your trading skills. Trading's not about price forecasting, but it's also about good risk management. Losing trades will happen. It's all right to lose your shirt. Just don't lose your pants, because that's where your wallet's at for you guys, right? Most guys have their wallet in their pocket. I mean, people say, I lost my shirt in the market. Well, okay, you're going to have a bad day. You're going to have a bad week. I get that. But if you lose your shirt and your pants, then you got problems. You got no more money to get back in the game. Risk management is key. And the techniques that we've illustrated today, as well as the topics to cover. This is a introductory webinar. This is not a full-fledged seminar. This is not chock full of details. If you are interested in finding out more about us, then simply shoot us an email. I can be contacted at jperson@personsplanet.com, or you can simply come visit our website, which I encourage you to do. You can visit personsplanet.com, the homepage here. A lot of great stuff that's up in here. Great articles in here, candlesticks in conjunction with pivot points. We can find all kinds of things if you're interested in other books and courses, events, seminars, where I'm going to be, for example. The information is right here on the webpage. With that said, this was an instructional tutoring session. Nothing really to talk about as far as any products to sell you. I'm not jamming anything down anyone's throat. This is all about seeing our friends and our trading community and giving you an introduction to what I've seen for 2016. What are the indicators I'm looking at, and what are the anomalies and unusual occurrences that I see in the market right now, particularly as I identified with some of the BD, the broker-dealers, as well as looking at the correction that already ensued in the transportation sector. So with that said, I wish everyone a great trading week, and I look forward to the next event when we do one probably in the next week or two, which we'll probably have some follow-up with some educational information as we get heavier into earnings season. So with that, I say thank you all very much and have a wonderful trading year. Remember, trade size. It's key to importance. Trade size. Everyone, have a great evening. Thank you for attending today.